or a scale-up, or even a corporate. This is at the essence of effective governance. So, and without this language, it's going to be very difficult for you, no matter which organization you work with. But at any point in your time, you will be taking on a project, you will be taking on a new program, you will be launching a venture. And by doing this, you will need to understand the financial fundamentals of such an organization, and be able to adapt your decisions accordingly. So what we're going to cover, and we'll do it in two sessions. We have today the sessions for about an hour and a half, and then we'll do another session to continue and to follow up on this, because I'm sure a lot of you will have plenty of questions. Now, the way we will do it is through case studies, and we will have two case studies which are important, and these are real life situations with real companies with whom we have been working, and these companies had to go through the same sort of process that we'll be discussing. So instead of talking about theory, we'll be really looking at practical cases, real life situations that are important to understand and to see how the organization has adapted to this. Okay, so let me. I'm sorry, we have people coming in as we speak, and we have the slides, please. Okay, so what we will do now, so what we will cover is why is this topic important? Why is it important? No matter what your role, no matter what is your function today, you have to look at yourself in 2 years, 3 years, or 5 years down the road. What will be the responsibilities that you have? So I will share with you why I believe this is fundamental. Then we'll have a brief introduction to financial statements. So what are those statements? And a number of you have been through it. What we will do is we'll do it through the case study. So that we will put you as a board member, and we will ask you to see how would you react when you have such a situation facing you. You have a budget. Is this budget make sense? Would you approve this budget? And if not, what would you do to change? So we will have this case study, which will be of relevance to a number of you. We will then go through the financial ratios, which is to mute all. So we'll go through the financial ratios to see how are those statements interpreted by others. Others means potential investor, existing investor, future investor. How do they go about taking these numbers and making decisions whether or not to invest in your company or to invest in your projects, to invest in your venture, and if they do, upon which condition? So you need to understand the mindset of those who are putting money in the organization. What are those ratios that are determining whether or not they will go ahead and try to fund you? We will then focus on the cash flow. The cash flow aspect, and if we don't have the time today, it's okay. The cash flow aspect is groups, if you want, the income statement and the balance sheet, and is the most important vehicle and tool in any organization. And the more you understand it, the more you're on top of your cash flow forecast, you're in a better position to understand what are your funding gap, how much money do you need, how are you going to use this money, at which valuation are you going to get new investors on board. So all of those are into the cash flow forecast. The more you understand cash flow forecasting, the more you're on top of cash flow forecasting, the better are your chances to, one, manage your venture, two, attract investors to this venture, and three, ensure that whatever surprises are coming, these surprises will be dealt with in the proper way and the proper time. So this is at the essence. The two case studies I've mentioned, one is Joysam, Ghana. We might even have Sam as part of, he's the CEO of this organization, and he has given us the approval to go ahead and to share this as a case study for a number of other social enterprises and scale-ups that are here. So we have the second one is the Allianz Financials. One of the key stakeholders that we have in this with us today is DHS, MIC, Canon International. And what we have done here is that we have taken the financials of Allianz, which was, as you know, one of your key partners in the past and will still be an important partner moving forward, so that you apply what we have learned to the Allianz case. So for those of you who will have another session, look at the Allianz case and what sort of recommendation are we going to take. We won't have the time to do both, but all of you have received the Allianz financials. Now, for those of you who did not have the slides or who did not have the case study of Allianz and Joysam, please send an email to Joanna. She's on the call. She's our new project coordinator in CS Touch, and she'll be more than happy to send you the slides and the 2 case studies that we have, and be able, in case you have any questions, to filter to be able to answer them. So this is in terms of the agenda. Joanna, just put your email on the chat box. This will be great, so that people who did not access it will be able to do so. Thank you. Okay, next slide, please. So let me start. And I have with me Lama, who is sitting down with me. She's the lead advisor in CS Touch. We've been working together for the past 2 years. She comes with close to 20 years of experience in management consulting, in corporate banking, and lately in helping scale-ups and corporates transform, access funding, and restructure their organization. We will be sharing this among both of us, as we do with a number of other conferences that we have. So blessed to have her here on this call, and also for the journey that we have shared together. So why is financial management important? So financial management is at the core of all business decisions. And what sort of business decision? And this is across any type of organization, across any size, whether you're a startup, scale up, corporate, for-profit, non-profit. All of you will have to be familiar with this language. One, it's in terms of performance evaluation. So this is a way to assess the performance of the organization. And there is a performance and there is a score that the banks will give based on your financial performance and based on these ratio analysis. The number two, it's fundamental to decide how are we going to allocate resources. One of the key decisions that most boards face is we're getting the money. How are we going to use the money across the organization, in which function, in which new venture, in which new product? So the whole resource allocation is at the core of successful organization. You need to understand this process and you need to be efficient at doing it. And financial management is there as a tool to help you. The value optimization, once you run it, and you will see automatically what derives at the end of each year, we know what is the value that has been created in the organization. We know what is the value of the organization at the end of it, and we know how much value have been created or destroyed. So this is very important for the accountability of the CEO or for the accountability of the leadership team that is running the organization. Strategic planning and forecasting, you cannot have a strategic plan if once you have agreed on what are your strategic priorities, these strategic priorities have a related investment, either in CapEx, in OpEx, in working capital, and these will have a certain way to influence the future of this organization. So the linkage between strategic planning and financial management is essential. Basically, you don't have a strategic plan without a well-integrated financial. And lastly, it's probably the most effective way to communicate to your stakeholders. And these stakeholders are not only your investors, not only your bankers, they're your creditors, they're your employees, they're the regulators, government officials, that you have potential partners, large customers, a number of them. The first thing they ask you is show us your audited financial statement over the past 2 years. This is every time, if they want to know what is the health of the organization, show us the financial statements that you have. So these are the elements why it's important. I'm going to underline by looking at the next slide and taking, a number of you, I'm sit on the board of several of the organizations that are present on this call today. And what are the topics? These topics that we discuss at board are typically, most of them are related to financial statements. So the first one that any board has to do is to approve audited financial statement. The first thing, you have to approve it, and you have to appoint an external auditor at least every 3 to 5 years that you have. So this is the first, and for you to approve it, you need to understand it. You need to know what you're signing for, because as a member of the board of directors, you're financially liable. In case there is anything wrong and you're not protecting the interest of the shareholder, you as a board director, you are liable for not protecting the interest of the shareholders. So you better know what you're signing and what you're approving. The second one that you need to approve is the annual or the long-term strategic plan and the related financial budget. It's also the responsibility of the board to do this. You also need to approve key investment opportunities. Why do I invest in project A versus project B versus project G? This is the most important decision because our funds are limited. So where do we put our funds? What do we do with this money? So this is also financially related. Approval of the dividend policy. A number of you are very profitable and you have very healthy profit, and these profits, part of them go back to the shareholders, and another part go back to the organization. So investing, the dividend policy needs to be clarified, and it needs to be consistent with a period of time. I'm sorry, I was given the feedback that I should slow down. So a number of you know me, so you know how passionate I am on this. So we have dividend policy. The other one is the compensation plan. Now we sit down with the chairman of organization and we need to define the compensation. How do you define a compensation plan? You define it primarily based on the financial achievements that you place and what is the performance versus what we have budgeted for. And based on this, we define what is the bonus, what could be the long-term retention plan. So it's also an important element in deciding on compensation. Also, the approval for funding rounds. Several of you have gone through funding rounds. You will go through new funding rounds. And the first thing when you go to a funding round in a data room, the first element, again, audited financial statement, your financial projections for the next 5 years, the audited financial statement for the last 2 or 3 years. What are your investment opportunities? What are your growth initiatives going to come from? So they all come to the same sort of language and the same sort of hiring and compensation of key executive I've mentioned. The risk management framework, you will see that when we go through the process, at the end of the day, you might have a number of factors that could derail this process. It could be external factors, it could be internal factors, it could be devaluation of the currency, it could be capital controls, it could be higher interest rates, it could be no funding available in the country. So you need to develop your risk management framework. And this risk management framework, a big chunk of it is what are the financial risks that you have and how do we go about mitigating these risks. The cash flow forecast, I've mentioned how important cash flow forecasting is. And for those of you who have known me and been on the board, this is the one thing that I insist for every single board meeting. We start with your cash flow forecast. If you don't understand your cash flow forecast and you don't deliver upon your cash flow forecast, there is something fundamentally wrong in the way you run the organization. So a number of you don't even know what cash flow forecast is. It's important that you get to know it. It's important that you understand how to develop it. And it's important that you understand how do you go and manage it so that the actual cash flow forecast, the actual cash flow situation is as close to the cash flow forecast as possible. And this is as much as an art as it is a science behind it. And for those of you who have 10 or 15 or 20 years, you know what I mean. But it is fundamental behind. And then the other elements, I don't want to go through it, but the optimal capital structure is important. How much debt versus equity? This again is a financial matter. Reviewing internal audit reports, all of those. So if you look, these are the list of items that are discussed at board level, and all of these items, of most of these items, are related to financial matters. Now, for some of you, you've been through it. You understand it. You have, and you will be, but it's a refresher, and you need this refresher. And trust me, not only you need the refresher, you need to make sure that you have someone in your team who could understand this language, hold your hand, and help you address whatever question mark you will have, because you will have question mark. As we go through boards and as we go through important investment decisions, there will always be question marks, and these question marks needs to be answered. And if you don't have the answer, get someone who has the answer. I'm very privileged, we are, Lama and I, to be sitting on the board of a number of the organizations, and we know what are those question marks coming in. And because of the experience that we had over the past 40 years, is to be able to know how other companies have reacted in a similar situation. So this is the why. This is the why it's important. And this is why you say, Constantin, it seems like Chinese. It is stretchy. And I would say you're right. It is Chinese for a number of you. It is stretching you out of your comfort zone, but the same way it was stretching me out. I'm a boring engineer. I did my engineering study in renewable energy back 40 years ago, actually more than 40 years ago. It was 44 years ago when I graduated, and I was on top of my university with my solar collector, and the other university was my windmill. And this was back in 1979 and 1980. And I had zero understanding of finance, zero. So there is positive news for some of you as you will try to, because it is easy to understand. And we're here to help you. So Lama, myself, the rest of the team are here. So whatever questions you have, feel free to raise. So what I'll do is I'll go through it. I'm going to pass on to Lama, who will take you through the financial statements. I will then I will take over from Lama on the case study for Joy Sam to explain to you. Hopefully, all of you have received the case study on this, and then we're ready to discuss it and to review it together so that we could decide on this real life case, what do we do and how to apply the learnings that Lama will take you through the case study. So we will not be able to cover all the slides, but we will have a second session probably in about 3 or 4 weeks down the road. For those of you follow us on LinkedIn, all of those presentations and workshop, we're delivering it live just after this one. We're going with one of the social enterprise in Lebanon, Fabric Aid, and applying exactly this, reviewing their cash flow, understanding their situation, see what sort of funding gap they have. How do we go about addressing it? We just also were informed there is a number of you who are part and funded by Al-Fanar. We just also got a project for this over a period of time to be able to train investment management and investment readiness to close to 30 different enterprise, NGOs, and social enterprise on it. So this is something that we do because we know it is essential. We know that social enterprises and innovative companies need it, and we'll be happy to work with you, with your team, as we did in the past, and for those of you who are there for the first time, to do in the future. So upon this, I'm going to pass on to Lama, and she will cover this. I will take over in about half an hour, and we'll go through the case study of Joy Sam. Thank you.
Thank you, Constantin. Good morning, everyone. Very happy to have you all here. It's a large group, and it's also a diversified group. So I realized that some of you already know finance, have worked with financial statements, and this is just a refresher for you in preparation of the case study that Constantin will cover with you guys. And for others, this is very new. So we'll go slowly over the financial statements as a quick introduction, and then take it from there. The financial statements, when you talk about financial statements, we typically refer to 3 statements: the balance sheet, the income statement, and the cash flow statement. And as we will cover, as you will see, each of them has certain information that it's offering for us to have a comprehensive view of the company's standing in terms of where do we stand, how have we performed over the past year, and what is the cash position that we have and that we can forecast for later periods. The first one is the balance sheet. Rona, I will ask you to please start admitting yourself so that I don't get interrupted. Thank you. So the first financial statement is the balance sheet, and the balance sheet is a snapshot. So it will tell you at one point in time, usually end of the year. So let's say 31/12/2023, what was the position, what was the financial position of the company, of the organization. It applies to for-profit, it applies to NGOs that are not for-profit. So any organization has a balance sheet. It also applies at the individual level. So I myself, at the end of the year, have a balance sheet. I have a set of things that I owe to others. I have a set of things that I own. And then the difference between what I own and what I owe is what we call the equity or the shareholders' capital. So the balance sheet is split into 3 parts. One is the asset side, the other is the liability side, and the third one is the equity or shareholders' equity. On the asset side, we're showing what we own. So what are the assets that we owe, that we have possession over, that we have ownership over? And typically, those asset types are cash that we hold, inventory or stock for companies, organizations that have a production arm, that have a trading arm. So they hold inventory or stock. This can be the raw material, this could be the work in progress that they have, and this could be also the finished goods that they have. And then you have the receivables, which are a result of when you're selling your product or your service at through credit lines. So the customer will not pay you immediately in cash, you will give them 30 days, 90 days, it depends on the credit terms that you're giving. But since you delivered this product or the service, and since you're expecting to receive cash eventually in due time, this is an asset that you have. This is something that you have ownership over. And then you have the more long-term assets, which are equipment, machinery, land, building, pieces of furniture that you have, your laptops, your all the assets that are fixed assets, that are long-term assets. And these can be tangible, like the examples I've given, and they can be intangible. So a software company who has developed a software, who has a website, who has an e-commerce platform, all of these are assets, but they are intangible. And we have them on the balance sheet on the asset side. On the liability side, we have what we owe others, what we owe creditors. And typically creditors are either our suppliers. So when we are buying from suppliers with credit terms, so we're not paying our suppliers immediately for the raw materials or for the supplies that we're purchasing, but the suppliers are giving us also credit terms. But since we owe those suppliers, these will be part of the liabilities on the balance sheet. The other type of creditors are debt holders, typically banks or financial institutions that have lent us money, or business angels sometimes that have lent us money. And this could be either short-term or long-term. It could be subsidized, it could be interest-free, it could be paying interest. So it depends on the types of financing that we've received. But any type of financing where we owe creditors, suppliers, or debt holders, these are part of the liabilities on the balance sheet. And the last part in the balance sheet is the equity, and that's the difference between the asset side and the liability side. It is the bottom line. What do we have after paying our dues? What are we left with? And this is typically the contributed capital. When we established this organization, the capital that we contributed, the capital that we put in, and it's also the accumulation of profits that we have kept within the company, so that we have not distributed as dividends. Any accumulation of profit will stay as part of the shareholders' equity, because it is part of the value that we have in the company. So the equity side is usually contributed capital, retained earnings. When we raise funds, so for companies that are raising funds, they're raising equity funds. Any contributed capital under an equity fundraising will go under the shareholders' equity. So this is in summary what a balance sheet is. Now, I realized that the group that we have is very diversified. So the balance sheet of an insurance company is not the same as the balance sheet of a producing company, of a company that is in trade, of a bank. So for different industries, we have different balance sheets. The balance sheet that I'm showing here is a typical balance sheet of a company that sells products. So typically, as I mentioned, we have the asset side and the liability side. On the asset side, we have cash and bank. So these are the accounts that we have at banks, or the cash that we have in the company's vaults. We have the trade receivables. So these are what I mentioned before, what our clients owe us, and they will be paying in due term. We have the inventory or stock, and this is either raw material, this could be work in progress, or these are the stock that we have on the shelves waiting until we sell them. And these, we group them under current assets. Why? Because these are liquid. So these are the ones that we can convert into liquidity, into cash within a short period of time. On the other side, we have the non-current assets. These are typically long-term, and they can be tangible or intangible. Example of tangible fixed assets that we have here are land and building, machinery and equipment, furniture, office equipment, and other fixed assets. And those types of assets, usually we depreciate them. So just like when you have a car, the more you use this car, the more value it loses. And this is what we call the depreciation. And the asset that we put on the balance sheet is the asset that we have net of the depreciation that would have accumulated over the years. So this is the asset side. On the liability side, we have the payables to suppliers. We have the debt to banks, to business angels, or to other debt holders. And then we have the equity, which is the capital stock that we first invested in the company. we have our retained earnings, and we have the profit that we have generated during that specific year. And as you see, so this is for end of 2023. So this is a point in time. This is a snapshot. And then you have the assets are equal to your liabilities and equity. And this is how we say the balance sheet balances. Any difference means that there's something wrong with the numbers and they need to be adjusted for the balance sheet to always balance. So this is the first financial statement that we have covered. The second financial statement is the income statement. And the income statement is showing a flow of resources. So as opposed to the balance sheet, which was showing us a snapshot, one point in time, how does it look? The income statement will show what flows of income or of expenses we have witnessed throughout this period. Typically, it's yearly, but we always we see income statements that are quarterly, monthly, for a better performance evaluation and a business review and monitoring. So what is the income statement? It's also composed of two parts, the income and the expense side. So income is everything that is coming in as revenues to the company, and expenses are all the costs related to the provision of service or the production of the products that we have. So income is typically sales, revenues for companies or organizations that receive grants. This is part of their revenues. So these are on the income side. And the expenses could be everything that is related to the cost of production, which we call cost of goods sold or cost of producing the service. Selling, general and administrative expenses are everything that you can think of. So these are your utility bills, your marketing expenses, your legal expenses, your rent, the salaries that you pay. All of these go under SG&A. And then if you have borrowed money, any interest that you are paying is also part of your expenses. And finally, you pay tax on your net profit. The result of total income minus total expense is your net income. So these are all new wordings for some, but these are at the basis of financial statements. So what is net income? It's the result. It's the net. It's the bottom line on your income statement. This is what the money that you would have generated over this period of time. After paying all the expenses that you have, this is the money that you are left with. Here is an example of the income statement. So you have also for a similar company, and then when we show the case of Allianz, for those of you from EHS and from MIC, we will show an example of what a balance sheet and income statement of an insurance company look like. But this for now is a typical company that produces goods. So they have sales of 622,000. They have generated those during 2023. So over 12 months from January to December 2023, this is the revenue they have generated. This revenue, to be able to generate, cost them $285,000 or 46% of it. So the cost of goods sold is 46% of the revenues, which leaves them with a gross profit margin of 54%. So these are important wording. So revenues, cost of goods sold, and gross profit. We always look at the gross profit margin. This is a very important indicator here. The gross profit divided by the sales to show, before adding other expenses like utilities, salaries, and so on, what is the actual profitability behind this business model. So this is a business model where I'm selling products or services and I'm incurring a direct cost into selling those services or products. Then what is my gross profit? And this is before even deducting any other expense. So this is very important as a measure, and we will cover it later during the ratios. Then after the gross profit, we start so such as salaries, such as travel expenses, such as rent, marketing, legal, other SG&A, and then we reach a level in the income statement that we refer to as EBITDA. So what is EBITDA? It's earnings before interest, tax, depreciation, and amortization. And then this is what we call the operating profit. This is another key measure within the income statement, because it shows us this is then almost the net profit that we're getting. Not yet, because there are still expenses such as interest and tax that we need to deduct and depreciation, but this is the actual business model that we have with the expenses related to it. How profitable is it? So we always look at the EBITDA margin. For this company, in this example, it's at 25%, which is interesting enough. Then after the EBITDA, we start deducting depreciation, amortization. We reach the EBIT, earnings before interest and tax. Then we deduct financial expense or interest, and we reach the earnings before tax. And then we remove tax, and then we reach the net income. And this is the net margin, the net profit margin of 11%. So while we started with sales of 622,000, we reached a net income, the bottom line of 71,000. This is the money that we have generated over this financial period, which is 1 year period. And then the last financial statement is the cash flow statement. The cash flow statement, so the difference between the income statement and the cash flow statement is that in the income statement, there are elements that are not cash related. So when we sell on credit, when we provide our customers credit lines, this is not cash coming in. We are accruing for the revenue, we are receiving those revenues, but we did not receive cash. The cash flow statement will show you only the cash that you have received. On the expense side, the income statement will show you expenses that you have incurred, but you might not have necessarily paid for them. So, for example, if you have purchased raw material from your suppliers that you use in the production, these will go into your cost of goods sold, but cash did not get out of the company. The same way as depreciation, this is reflecting the actual side of assets losing their value with time, but there's no cash transaction that's happening. So this is the benefit of the cash flow statement, which is only showing a version of an income statement, but only looking at the cash components with it. And the cash flow statement is built through 3 components, 3 building blocks. The first one is the cash flow from operating activities. Then you have cash flow from investing activities, and the third one is cash flow from financing activities. The first one is related to the operations. So this is cash coming in and coming out related to the operations. It could be the revenues that you're generating, the expenses that you're incurring, paying salaries, paying rent, paying interest. So all of those are related to the operating activities that you have, and we put them in one bucket. How do we calculate them? We take the bottom line from the income statement, we adjust it by adding back or deducting the non-cash expenses to it, and we also reflect changes in the balance sheet that have not been captured by the income statement, which are the changes in working capital. So what is working capital? Working capital is the change in your current assets and current liabilities. This is your receivables, this is your inventory, and this is your payable, typically. So when your working capital increases, it means that you have, take the example of receivables, for example. When your client comes and pays for the product that they had purchased previously, this is cash coming in. So we reflect this change in accounts receivable, this decrease in accounts receivable, as a cash inflow into the company, and we reflect it into the operating activities. Same thing for the suppliers. So when you're paying your suppliers, the payable account in the balance sheet would have changed, and this means a cash outflow from the company that is captured under cash flow from operations. The second building block is cash flow from investing activities. And this is typically related to the purchasing or sale, so purchase or sale of fixed assets, of equity, of equipment, of machinery that you have. So when I make an investment by buying a warehouse for my organization, this is cash that has left the company. It was not mirrored in the income statement. It was mirrored in the balance sheet, but it was cash that came out of the company. We reflected here under cash flow from investing activities. if I'm selling something, if I'm selling the company car, this is cash inflow. It would be reflected on the balance sheet and the cash flow statement as a cash inflow because the asset part would have gone down. The last building block is cash flow from financing activities. And these are related to the debt and equity part of the balance sheet. This is when you're issuing debt or when you're issuing equity, or also when you're paying back debt or you are repurchasing equity or paying dividends to your existing shareholders. So any change in cash that is under those components, that are under those themes, will be reflected under cash flow from financing activities. And the bottom line from the cash flow statement is your cash position. So that was your cash position at the beginning of the year. These are the changes that have happened, whether on the operating side, whether on the investing side, or on the financing side. And the result is your cash position at the end of the year. And this is what Constantin mentioned before as the cash flow forecast. We need to do this for every single year, not the ones that passed, but also the ones that are coming, to understand, based on the projections that we have and on the cash flow statement, what will be the cash position at the end of the year. Do we have a financing gap? Do we need to bridge this gap by issuing shares, by issuing debt, by borrowing money? And how do we continue year over year? So I'll show an example again of the cash flow statement. Same company that we've been looking at. So this is a company producing products. We look at the cash from operating activities. As I said, this is taking the income statement bottom line, which is the net income, and adjusting it. And adjusting it with. Can you please mute? And adjusting it with changes in non-cash expenses like depreciation and changes in the working capital, so increases, decreases in inventory, receivables, or payables. Then we have the investing activities here. In this case, there's a minus 30,000 cash that went out of the company. So this meant that we have invested in fixed assets, and this is cash that a cash outflow. And then you notice that the long-term debt increased by 54,500, which meant that we have raised debt and we have received cash inflow into the company. We started with a cash position of 60,000. The changes in cash were a net increase of 20,000, which left us with a bottom with a cash flow with a cash position at the end of the year of 80,000. So here we covered the three financial statements: balance sheet, income statement, and cash flow statement. From each of those those financial statements, there are ratios that we look at, and those ratios either relate to the profitability of the company, of the level of activity that we have, of the liquidity position that we have, the gearing in terms of debt related, so how much have we borrowed versus how much have we invested in equity, and then the investor ratios that will encompass them all. I will not cover them all. I will just focus on the main ratios that we look at when we are analyzing financial statements. And these will bring us information into what has happened during this year, what is the financial position of this company. So from the income statement, the main profitability ratios that I would like to highlight are the gross margin. So this is gross profit divided by sales, and the net profit margin. I will add to it also the EBITDA margin. So these are three measures from the income statement. All of them are measures of profitability divided by sales. Thank you. That we look at to measure the profitability of the company. In terms of activity ratios, here we're looking at a combination of measures from the balance sheet and from the income statement to see how efficient we are. So we look at the inventory period. So how many days is it taking us to roll over this inventory? We look at the receivables period, which is typically how many days do we give our clients before they pay us back? And the payables period, which is also the number of days that our suppliers have given us before we pay back for the raw material or the supplies we have purchased from them. So there are many other financial ratios. Just for the time's sake, we will not cover them all. When we will send the slides at the end of this workshop, you will have them all. You will get to review them and look at them. The bottom line is that there's no single ratio that gives the full answer. And this is why in every board meeting and every business review session, we look at several ratios. And the combination of those different ratios will give us a clear picture of how profitable the company is, how efficient the company is, what is the cash flow position, and is it sustainable? Do they need to look at fundraising? And the combination of all this analysis will allow us to give recommendations in relation to the way forward and what are the action plan, the actions that need to be taken.
Great. Thank you. Lama, it was, I know it's a big mouthful for some of you, and it's a refresher for others. So it's always when we have close to 110 people in this session today. So you have some that are finance gurus, and you have others who never have put together a financial or never seen a financial statement. So trying to do and to address and add value to all of you is a challenge, and Lama has done a great job in explaining these three financial statements. Now, I want to pause at this stage. We're halfway through this hour and a half together, and before we go on a real-life case study, so this is a typical situation in a typical board that took place earlier this year with an organization that we have been working with for close to 10 years, that we have funded on this. I would like to stop and see whether there are any questions that you would like to raise. So any questions, can they unmute or not? Okay, you could unmute if you have a question.
Go ahead, Wissam.
Go ahead, Wissam.
Good morning, Lama. Good morning, Constantin. Hope all is well. Good morning, all. My name is Wissam Mattout. I have a quick question. Prior to the cash flow and the balance sheet and the rest, as a board member, how could I judge that my CFO is putting the right chart of account that suits my line of business or my type of business?
So, Wissam, thank you. Look, what's important is each one of you have your own chart of account. So this is developed tightly with your external auditor, and in some cases with your internal auditor. So there needs to be an alignment in terms of your business activity, your business approach, together with the other stakeholders in this case, which are your external auditor and your internal audit department. So this is work that needs to be done, and the way you do it is you do it through your financial management standard operating procedure, SOP. So these SOPs document all the if you want, the guidelines and all the that would help you ensure that the quality of the chart of accounts is what it needs to be. Something went wrong. Okay, so and we'll be happy also to share, for those who are interested, some of you have also asked this, to share an example of what are those standard operating procedures for financial management practices. We have similar operating procedure for human resource. We have similar that we have for credit control, for collection. So all of those are documented in these SOPs. These SOPs, people are then trained on these standard operating procedures. And these SOPs typically are also being automated. So by whatever system you use, whether ERP, whether another system that you're using, that we have. And there is internal audit who's here to ensure that those standard operating procedure are being applied the right way so as to avoid any deviations. And the role of internal audit is to highlight risk areas that could potentially could arise from the fact that some of these SOPs are not implemented the way that needs to be implemented. And typically these are done from an accounting perspective according to either international accounting standards, or they're done to whatever are the local acceptable accounting standards in the country or the jurisdiction that you're working with. Thank you. Any other questions that come up? No other questions? Okay, what we're going to do is we're going to look at the case study. So this is the case study. This is a company that is close to my heart. I don't know if Sam is on the call. Sam is the founder with his wife, and this company is part of the Stanford Seed. This is a program that I've been associated with my alma mater, the Stanford Graduate School of Business. And Joy Sam is one of the most impactful social enterprise that has been working over many years, and their main mission is to be able to provide access to safe water in rural areas across West Africa. They started in Ghana, expanded into Gabon, looking at other growth opportunities behind it. But access to clean water is probably one of the most fundamental needs that today is still not addressed for millions of tens of millions of people in emerging economies. So the way we've worked with them is the way we worked with a number of other organizations. We helped them put together that transformation plan. We have also helped them. We joined the board. We're members of the board, both Lama and I. And in the board, we help them put together the balanced scorecard, put together the budgeting process, ensure that we have clear key performance indicators, looking at cash flow forecasting, looking at credit collection, at aging of collection. So all of those elements, which are the core essence of proper governance, have been implemented. We also have extended, not only in terms of advisor, not only in terms of a board member, but also in terms of providing them with funding. So in this case, we're providing them with debt funding that would help them in terms of accelerate their transformation and increase the impact that they have been generating. Next slide, please. So who are they? This is the pain point they're addressing, as I mentioned, is really access to clean water. And this is a huge issue. 1 in 3 African citizens are impacted by water scarcity. 400 million people in sub-Saharan Africa lack access to basic drinking water behind it. And Joy Sam is really at the core in trying to resolve this issue. The way they do it is that they look at the soil, analyze the soil, do the borehole, install the pump, and this pump could be like on the right picture, a hand pump, or it could be a photovoltaic or solar-powered pump that you have in order to provide access to water. So they started the business back in 1996, so close to about 30 years ago. Is the provision of quality water and general civil engineering works, primarily in rural areas. Their mission is to enhance the quality of lifestyle, and the way that I love this picture with this child smiling by providing professional services to make available essential natural resources so there's clean water in rural communities. Next slide, please. So the key milestone that they have done is they expanded to West Africa from Ghana. They hired and retained a number of people. They've developed these people. They've formed partnerships with NGOs, because NGOs are a number of cases. They're the one funding these borehole drilling and access to water, or it could be municipalities, or it could be government organization. And they've been, awarded as the Invest in Africa's Scale Up Business of the Year. So this is what they've done is they've drilled about 5,000 borehole. The aim is to be able to drill a few more thousands in the years to come, and to be able to provide access to 13 million people in rural Africa. So this, for me, is at the essence of what a social enterprise is all about. It's not only about making your profits and growing your business, it's also about ensuring that you're generating the impact and making sure that this impact is sizable, is measurable, and is sustainable with time. So these are the type of companies that we focus on. It's not only companies that can grow and can make profit, but also companies that have a clear social impact agenda, where most of the profit is invested into these social activities that they have, and being able to expand. So this is now you are board members. All 110 of you are members of this board. These are the results. So we shared with you the results from 2017 to 2023. So this is the actual results, with, of course, the full approval of the CEO and the co-founders of this organization. This is the operating profit that they have been generated, and this is the net income. If you go back to what Lama has covered with you, a real-life case. So if we look at 2023, the revenue was about 6.8 million Ghana CD. The cost of sale, which is the cost of producing, in this case, what they're doing is that they're installing the borehole. So it includes the spare parts, it includes the labor to drill for this, to make sure that we have access to the water, amounts to about 4.6 million. They live on, and what you have is you have operating expenses, which are sales, admin, and general expenses, which are, and then moves you from gross profit, which is basically your revenue minus your cost of goods sold. You remove the operating expenses, you get to your operating profit, which we call the earning before interest and tax that you have. You have some financing costs that are associated with it. And then from this, you go back to your net income. Next slide, please. So what you have here is the presentation that took place a few months ago. And this is what has been presented. So this is the results for 2023. And this is the budget for 2024. So in the budget, you have both the income statements on the left, and you have the balance sheet on the right. So again, the income statements, revenue, minus your cost of goods sold, gets you to the gross profit, minus your operating expenses, gets you to your operating profit, minus whatever financing cost you have, gets you to the earning before tax, minus your tax, gets you to their net income. So this is where they were in 2023. This is what they're presenting for 2024. So what you have on the right side is your balance sheet. So what you have here is the assets. So this is how much cash they had at the end of the year in 2023. This is what they're aiming for 2024. These are the receivables, a big increase in the receivables, as you could see, from 2.5 million to 4.2. Inventory is under control from 3.7 to 3.5. Property, plant of equipment, they've done depreciation of some of their fixed assets. And then they have this investments in Gabon where they're being able to collect some of it and reduce it. So their total assets move from 7.45 to about 8.6 million. How are they funding it? Through loans. So you have some long-term loans, you have other loans, you have some payables that are coming. And then the difference between your assets and your liability ends up being your shareholder equity. So this is what has been presented. This is a real board life case that you have. So what we've done is not only we shared with you the income statement and the balance sheet, we also shared with you some of the ratios that Lama has covered with you. So what are the key ratios that we have? The asset turnover is a measure of efficiency. The OPEX as a percentage of revenue is how efficient you are in managing your operating expenses. Your current ratio is more in terms of your liquidity. So how your current assets versus your current liability. The return on your capital employed is your operating profit divided by your capital employed, which are basically your equity and your debt position that you have. And then you have other efficiency ratios, which includes the receivables, which we measure by what we call day sales outstanding, the DSO, moving from 138 days to 88 days, so an improvement in the DSO. So they will be collecting money in a more efficient way. Their inventory, the days inventory from 299 days to 110 days, so they're also more efficient in managing their inventory. And the payables that they have in terms of the suppliers, they are paying their suppliers a bit faster. So overall, their cash conversion cycle, which is your receivables plus your inventory in number of days minus your payables, is reduced from 238 days to 105 days. So this is the proposed budget. This is a social enterprise existing in Ghana, expanding across West Africa. You are a member of the board. I'm asking you to go through it and to tell me, one, do you have any questions on this? And two, are you approving it? And if you're not approving it, what will be the questions that you have, or what will be the conditions that you will ask in order to make sure that this budget makes sense? So Josephine is the first one to have raised her hand. Josephine, the floor is yours. Go ahead, unmute, and ask your question.
Constantin, I see they have 158% as the projected growth. Do they have a basis for it?
Okay, this is a great question, Josephine. So the first question is this is an extremely aggressive growth rate. So they're basically close to tripling their business, close to. So it's more than 2.5 times. So this is very aggressive. The first question, it's a great question, Josephine, is what is the base of this growth? So where is this growth going to come from? So we asked the question and we got a list of the projects that Joy Sam was going to deliver, where they have commitment, strong commitment from the customer. You have to understand that this is an election year in Ghana, and typically in election year, this is where you have a lot of the municipalities that want to make sure that everybody are happy. So this is where you have a lot of funding of these water access projects, because this is at the core of making people happy. So to answer your question, there have been a list. Now, I take your question even more seriously, because what we have done is what you probably would have done is say, look, we understand it. We look at what we call the funnel. So this funnel shows that you have at least 2/3, or let's say half of your project secured behind it. We still believe this is too aggressive. We don't want to be in a situation where you go for very aggressive growth in terms of revenue, and then you have also growth in terms of your operating expenses, and find yourself in a situation where your revenue drops. We've made the investments, and this hits our bottom line. So our recommendation here, based on your question, Josephine, is that we have asked them to review the revenue a little bit lower by about 20 to 30% to ensure that there is 100% probability of achieving these numbers. So great questions, Josephine. Wissam, any questions from your side?
I see that there is a good growth in terms of the growth rate is high, while looking into the profit margin, though the profit is increasing, but the profit margin is decreasing from 32.4 to 30.4. It's down by 2 points. And the same, the liabilities are increasing a little bit. We can consider that it's remaining the same. Any specific reason for both?
Excellent. Another great question, Wissam. Thank you for raising it. Josephine, also thank you for raising it on it. So the question is that you have been growing your business. It is fine. But what we realize is that your gross profit has been reduced. So why we want, it's already 32.4 is already quite competitive to be able to cover your expenses, because you are barely breaking even in 2023. So in this case, you're coming up with a lower gross profit. The answer that came in is because of the number of projects that are coming in, and there is a lot of competition. They expect to be able to adapt to achieve this growth. They need to come up with about 2 percentage points in order to win some of these projects, which are government projects, which are very strategic, where the profitability, unfortunately, they squeeze you, because it's really based not so much on the value that you distribute, that you provide, but a lot also on your the quotation that you have. So what we said, and is we said, fine, we are happy to reduce your budget, reduce the budget in terms of revenue, but then focus, keep the ones that have a higher gross profit. So while you drop your revenue by 20 to 30%, we expect you to improve your, or at least protect your gross profit margin, so as to avoid this erosion that will make it a bit more difficult to do it. So another great question. I will also go a step further, Wissam, in your direction. It's not only what will concern a bit is that as you're growing your business, not only you're dropping, we believe that you're not investing as much as you need. If you look at your sales, admin, and general expenses, those are growing much lower than the growth of your revenue. So the key questions here, you are maybe under investing in your organization that you have, and you might be stretching your organization too thin. So one of the comments is not only to protect your gross profit margin, but we would like you to also look at your admin general expense, and maybe look at either at hiring additional people so as to be in a position to be able to deliver. You cannot triple your revenue, and you cannot, more than 2.5 times your gross profit while you're increasing your operating expenses by about 30 or 40%. So this was another comment that we have. So two great questions. Josephine, is this, no, before Josephine, because Viral, go ahead. Hi, Viral, long time no talk.
Hi, Constantin. Hi, everyone. My question is how they've improved their cash conversion cycle so much between 2023 and what they're anticipating for 2024 budget.
Very good. Viral, I'm very happy that you asked this question, and it's coming from you. So it's Viral is the CEO of an organization in Kenya. We have people from different countries in this call. So Viral, it's a great question, and we zoomed in. We zoomed in on this one. So we said, look, how are you going to grow your business by close to 3 times when you're going to reduce your receivables, i.e. what you're doing is you're reducing your payment, your credit terms with your customer who used to pay in about, let's say, 4 months, 4.5 months, and you want them to start paying in less than 3 months. This is extremely difficult to achieve. So we believe that we want you to improve your DSO. We want you to improve, to reduce the extended payment term that you have to some of the customers, but do it in a realistic way. So 138 to 88 days is for us too sharp of a drop. We want you to look at it carefully, and we want you to maybe look at probably around 100 or 110 days, so as not to jeopardize the opportunities that you have to grow. So this is the one point. So this is important. The same applies to the inventory. There is no way if you are used to have, because of the nature of your business, you need to carry spare parts because hand pumps or others need to have spare parts. So your inventory is a high inventory, which in this case is close to 300 days. To move from 300 days inventory to 110 days inventory, this doesn't make sense. You will jeopardize your ability to be able to grow your business if you reduce. We want you to reduce your inventory, but do it in a way that is rational. Do it in a way like, for instance, for 300 days to maybe 200 or 220 days, and then the following year reduce it. But to go with a sharp drop, it doesn't make sense. So both on the receivable and on the inventory, it doesn't make sense, and it doesn't support the aggressive growth that you're shooting for. So we ask them to go back and to revise those two numbers. On the payable side, it's the other way around. Why do you want to improve the payments to your suppliers when they're happy with maybe they're not very happy, but they accept 200 days, and to bring it down by more than a half? Why do you do this? It is affecting your cash flow. You do this. So in some ways, it's a bit counterintuitive on it, because you need to do it in a way that is also gradual. So what we're saying is increase your DSO, let's say to about 110 days, increase your DIO maybe to about 200 days, and then decrease, your DIO, increase your DIO from 110 days to, let's say, close to 200 days, but also increase your payables. So because we want to be good with our suppliers, but our suppliers are used to 210 days, maybe let's drop it to 150 days and the following year. So this decrease in the cash conversion cycle from 238 days to 105 days is not feasible in an environment where you're growing your business in such an aggressive way. So great questions. All questions I've done are great questions. Any other questions that you have? Thank you, Viral. Any other questions?
Constantin,
so we have Josephine. Yes, Wissam, go ahead.
Pardon me. Can you reflect on the point I mentioned of the total liabilities? It's almost the same in 2023 and 2024.
Okay, the total liabilities that you have, yes. So if you look at the total liability, what they have done is that they have reduced some of the long-term loan that would do. By the way, one of the long-term loan is my loan to them. So this is the plan, is to reduce it, but they've done it by stretching their suppliers. So what they've done is that they have, by stretching them in terms of total number, but actually reducing them in terms of DPO. So what they have done here is that they say, look, we have a leverage position which is a bit on the high side compared to our debt to equity. We want to bring a lower leverage ratios that we have in 2023, which I think makes sense. But we are doing it to the extent of the payable. So we will be exceeding. So this is how they've done. So they've done is reduction in terms of their loan, which is the long-term liability they carry. And they have done it by looking at their payables and basically stretching from a dollar perspective the payables that they have. So this is how they've done. What we're saying is that you need to stretch your payables even more. So in terms of your total liability. So maybe for the volume that you want to do, maybe 4 million or 4.5 million would be correct. If you look at because what matters are the days payable outstanding, but at the same time, relook at your receivable. Maybe you'd like to increase your receivable a bit and you want to increase the inventory a bit. So the total figure will have to be reviewed so as to reflect for this level of revenue, higher receivable that compared to 2023, higher inventory compared to 2023. We have maybe a little bit lower loans because they make use of those cash position to pay back your loans, but also higher payables that you have. So this is our feedback to them from what they have in terms of total liability today, which is pretty similar we expect those liabilities in some ways to evolve with the feedback that I have provided you. Wissam, thank you. Josephine, this is a new hand.
Constantin, the other income, 2024, it's not there. Is it because you reduce your DPO? Because if your loan is coming down and you're giving your suppliers the 90 days versus 199, is that why they don't have other income as a provision?
Yes, good question. What happens in a number of these social enterprises, and a number of you on this call are social enterprises, what happens is that your mission is such a strong one that you have a lot of donors and a lot of grant providers who are happy to extend a grant. So how do you account for those grants? So you account for those grants as other income. So you won't put it in your gross profit. You don't put it in your revenue, because your revenue is what you're invoicing to your customer. We put it on a separate line, which we call it other income. So the other income will be the grants that, and they might. Today, we didn't have a visibility for 2024, but the way it is coming is that they will get some sort of grant, but they could not budget for it. So we expect that there will be some other income coming also in 2024 because of their strong value proposition, because of the impact they create, and because of the fact that what the pain point that they're addressing is the pain point that German GIZ, USAID, French Proparco, and others, the Swedish International Development Agency, the Dutch, are all interested in supporting social enterprises that are. So this is why you have other income. It's not budgeted for because they're conservative. They could not budget if they did not 100% sure to get it. The reality is that they got it. And so that the real numbers will be a bit higher in terms of their other income. Wissam, go ahead.
I made it a lot today, so pardon me.
Yes.
In terms of DPO, the reduction is massive, 100 days almost. Is there a way that this will return into some profit to the company, hitting the bottom line directly, like early payment discounts?
Yes, excellent question again. So what you do is that when you are reducing your DPO, in this case, it's a substantial. The only justification that you could get is, look, if I'm paying in 200 days and now I'm paying in 90 days on average, because some of them might be lower or higher, is that I'm expecting the supplier to say, okay, you're changing, you're paying me faster, I'm willing to give you not a prompt payment discount, but I'm willing to give you an additional discount because interests are high. When I'm reducing my payables by 100 days, in some ways what I'm doing, because the cost of borrowing is very high. I mean, depending which country you are in, but it could be as high in some of the countries of 15% on US dollar loan. So if you're carrying it's like here with your suppliers, you are the banker of these suppliers. So in some ways you expect, if you're paying them prompter, that you expect that there's going to be additional discount. And where is this additional discount reflect? It will reflect into your gross profit margin. So this will be, so expect there is a reduction, but we don't want it to be too sharp. At the same time, we want it to go into a good trend, but we also want to make sure that your level of inventory and level of receivable is high. So all of those are wonderful questions. Now, time is running out. I'm going to stop on this. This is a clear example of what those board discussions are about. So all the questions that you have raised are great questions. All these questions were reflected to the leadership team, to the CEO. They went back to the board, covered it, came back, and came up with a budget which was much more realistic. It's much more aligned with what we had, so that we were happy to approve it and to make sure it delivers. Maybe the only comments that I would have raised in this, I think you covered it all. I'm trying to look at it. I think this is covered. So the key here is to make sure that from, if you look at total equity, the total equity in 2023 was thin. So it was 1.1 million. And if you look at the total loan that they had loans of close to about 4 million. So we're talking about a debt to equity ratio of 4:1, which is very high. So we wanted to make sure, plus the fact that it's a high interest environment, this is affecting the overall financing costs. So it's important to reduce the financing costs that came in. You had an EBIT margins of 6.4, the financing cost. So we will put a pressure, and this is what we've done, is deleverage. Ghana, like a number of other countries, you look at Kenya, some of you are from Kenya, some of you are from Lebanon, all of those countries are going through extremely difficult situation. Even in Tunisia, we have some Tunisian friends on the call. So all of those are going through very difficult times. The governments are going to be difficult time. Why? Because of actually the ratios. The governments have too high debt. The governments are not in a position to be able to balance their budgets. The governments are so they have to go down and cut some of these operating expenses. And the impact of their inability to be able to do this, what happens is that the IMF or other organization resist the funding of this, which makes the situation even more difficult, and automatically interest rates increase, and automatically devaluation takes place. So what is happening from a company perspective in terms of financial ratio is actually happening on a country level, and will of course impact the results, because higher interest rates will mean higher financing costs, etc. So great question. So the only one that we would have added is deleverage. Deleverage, in some ways they've done it. If you look at their total equity in 2024, it's about 3.5 million in terms of total. It's a total equity is 2.2 million, where the total debt is coming down to about let's say about 3.1 or 3.2 million. So moving from 4 to 1 to moving to 2 to 3. So which is much better. What we're telling them is, if we have the cash, that what we need to do is we need to make sure that we could also reduce further your debt position, so that you don't have this burden of additional financing costs that are eroding your margin. And if you could see in their budget, their financing costs have gone down from 429 to 347 in a raising interest rate environment. Okay, I'm going to stop here. Is there another slides behind this? Okay, what we want to do is, don't go quickly. I'm going to stop. Any questions that you have on the case study? So you have Shital, go ahead.
Hi,
Shital.
Constantin. Hi, Lama. My question was, in terms of the growth of 158% and even the net margin of 9.02%, I mean,
Yes.
How confident are they in terms of, risks for this forecast? But you've sort of just explained it. So that was actually my question.
Okay, but Shital, look, it's a great question. I'll tell you why. Because it's bringing up a point that is essential. So whenever you come up with this budget, any company that comes up with a budget, there are risks associated with your ability to be able to deliver on this budget. And these risks are clear, especially if you're looking for such an aggressive growth in an environment that is very tough. It's tough in terms of capital controls, tough in terms of devaluation, tough in terms of purchasing power loss, tough in terms of higher interest rates. So all of those are putting an impact on the organization. So what do we do, Shital? And this is an exercise that we have done with you and with your team about 5 years ago, and we're probably going to do this year later on with the leadership team during our offsite in Mombasa in September, is to conduct a risk management framework. So what we need to do, okay, this is our budget. This is what we want to do in the budget. We know it's a stretchy budget, but we also know these are the key risk areas that might impact our budget. So there could be loss of customers. It could be, that we're moving from an exclusive agreements that we have with a given supplier to one where we're non-exclusive, dealing with several suppliers, which is similar to what you have been facing in your organization, in your region. So this will have an impact on our gross profit. We don't know how big the impact is going to be. So what we do is we list those risk areas. We list them one after the other as a team. We then prioritize them. Which is the one that have the highest impact and which is the one that have the highest probability of happening. So this is what we call the red zone. So out of those risk areas, these are the 3, 4, or 5 that in our mind could be the one that will not allow us to deliver on our budget. So normally, for each budget that you propose, which is supported by a business plan listing the key priorities, key growth initiative that you have, which is basically the exercise that you and Ali and I have done over the past few weeks to do this. We know that there are risks involved. Let's list those risks and let's see what is the best way to address those risks. So doing the risk management framework is as important as doing your financial budget, because if I am on the board, I want to have a higher level of certainty that you and your team are able to deliver on the budget. If you share with me your budget and you share with me, these are the key risk areas, Constantin, these are the ones that have the highest impact and the highest probability. And this is what the mitigation action we as a team decided to implement in case these happens. I am much more comfortable in signing this because I know that the worst case scenario in some ways has been considered. And talking about worst case scenario, typically, and this is a message, and I know we have 12 minutes, so we will have another sessions, by the way. So I'm not trying to cover all the slides in this session. We'll have others because it's an important topic. In all situations, every single one of you, and the countries that you're in are operating in very difficult environment, everyone. And we've been visiting these countries, we've been exposed to these countries on it. So what I want is to link your cash flow not only with your budget, I want it to link it to your worst case scenario. So in some cases, what I'm saying is give me your worst case scenario, tell me how is this scenario, what could this scenario be, and what will be the steps that we need to take, either in terms of OPEX reduction, or in terms of fundraising, or in terms of trying to get additional business from other growth opportunities. So it's important that you look at your worst case scenario, you look at what is the impact on your worst case scenario on your cash flow forecast. So whatever could happen that could be the worst for this organization, are we well prepared? And I know a number of you have gone through extremely difficult time over the past 2 to 3 years for all the reasons, being in COVID, being in the political situation, being in the... And this is how I live my life. I live my life by looking at a certain situation. What is the worst that could happen? Understand what the worst thing, and then accept it in saying, if it happens, I'm ready to accept it. And these are the steps that will take place to make sure that this happens. So it's a great question because it leads me to one, the risk management framework, which is important. We will normally cover it, but we'll cover it at the end of it. We won't have the time this way. The second one is look at your worst case scenario and give me your cash flow forecast based on your worst case scenario. So I know, and this is a difficult one to do because CFOs and CEOs do not want to look at it, but our role as board is, this thing can happen. It has happened in the past. And we had a number of organizations who went through a worst case scenario, and some of you are on this call, and you know what I mean because we've been through it, and we went through it in very difficult times and very turbulent water. So great question, importance of risk management, importance of scenario planning by looking not only as a base case, but looking at a worst case scenario and what is the impact that you will have on your cash flow forecast. Okay, any other questions? We have 9 minutes left. I don't want to because you always tell me, Constantin, you are jamming and putting a lot of information too much. So we will have another session to cover because there is a lot of materials to be covered. Any other questions on what Lama has covered in terms of the financial statements, on the financial ratio, and on the case study? Any concerns, any feedback that you have, please feel free to raise it. We have the time. No feedback, no questions. Okay, so we'll continue. We will do a couple of slides here. So this one is on cash flow optimization and investment reprioritization. This is at the essence of what all of you will be going through as you grow your business. It's basically how do we, in difficult situation, how do we optimize our cash flow? Because we have a cash flow gap that we cannot address. And how do we go about prioritizing the different investments that we're facing? So the cash flow optimization, how do you go about it? I'll cover it and I'll let Lama cover the investment prioritization. I'm going to mute my my phone for just a second on it. Okay, so what we do is we have just to balance the situation. So on the cash flow optimization, it's important that you set variable cost versus fixed cost, and your challenge is to push as much as your fixed cost into variable costs as the situation becomes difficult. And this is not easy. It could be salaries that will be more commission-based, or there will be more results-based. It could be bonus. It could be other ways. It could be rent based on revenue and not so much based. So your challenge as a CEO, when the situation from a cash perspective becomes difficult, how much of my fixed costs can I shift into variable costs? Variable cost means that if my revenue drops, and of course my profit drops, can I drop also my operating expense? So this is important. And the fixed costs are typically rents, typically salaries, typically marketing expenses. So these are the typical ones. So keep this in mind. The second one is insourcing versus outsourcing. Do I really want to do everything myself? Are there functions that you believe that could be done better and more efficient if I outsource it? So this is a fundamental question that you need to ask yourself, is what is core for your organization versus what is non-core in terms of functions. But the third bullet point is also in terms of assets. So what is core that I need to have? Because this is the core of my business. These people are core to me. And what is non-core that I could outsource or that I could dispose? It's also a tough decision, but you have no choice but to go through this decision and to be able to understand what do you need to insource versus what you need to outsource, what is core versus non-core, and to be able to dispose some of these non-core. We are going just after this to two organizations. One of the organization is one of the most powerful organization, social and enterprise in Lebanon. They unfortunately went through a severe downgrade, a reduction in terms of revenue, and they had to cut their operating expenses by 50%. And trust me, to cut operating expenses by 50% is a very difficult situation, because you have to let go of people, you have to let go of many people behind it. But if you don't do this, you basically are putting the organization at stake. So whoever are remaining, the 50% of the people remaining, or these 60% remaining, at least you can protect them. And some of these tough decisions needs to be taken. How do you take it? Core versus non-core. So if I ask Shital and I tell her, Shital, you have about 20 people reporting to you. If I ask you, you have to today, unfortunately, we could only retain 15. Who are those 15 that you want? Who are the ones that are core, that are essential for you to be able to deliver, and who are the ones that are non-core? So these are tough decisions. And in my life, I'm turning 68. One of the toughest moments in my life when I was at HP at one point in time went through a very severe, this was back in the 90s. So we had a major crisis behind. We had the dot-com bubble burst that came in. And we had to let go in my own department close to 300 people. And these were all friends with whom I've been working with for the past 15, some of them even more. They have families, and they've always been working with Hewlett-Packard on this. And this decision I had to take, and it was the toughest decision in my life, because I know that there was impact on their families, and I hated myself for this. And this was one of the reasons why I decided that probably the way to go is more towards social enterprises, and not only to profit maximization thing, but this is a different story. But what I'm saying is, you as a CEO, if the situation goes back, you will need to go through these decisions. The third one is working capital. Where is your cash? The cash is not only in reducing operating expenses, in shifting your fixed costs into variable costs. Your cash is actually in your receivable, and your cash is also in your inventory. So this is why you have to focus on your working capital and see how you can squeeze your inventory, squeeze your receivable, by even offering prompt payment discounts, or by offering this special discount on some of the inventory that you have, so as to reduce your working capital. The working capital is the single most important reason why organizations go into bankruptcy mode. It's because they have too much in cash, too much in receivable, too much in inventory, and not enough in their. Are we still? Okay, we had welcome to Lebanon. We had electricity cut. So this is what we have. So this is the last one, is on adapting a short-term cash flow culture. So I'm interested in your cash flow forecast over the next 12 months. But the reality is, I want to know what's happening over the next 3 months. Not only I want to know what's happening, I want you to be on top of your cash flow forecast. So if you give me a cash flow forecast and you're plus or minus 90% of it, there is something fundamentally wrong in your ability to forecast over 3 months. And this, for me, is a major source of concern into the quality of the leadership that you have. So short-term cash flow forecasting becomes very important, and it's important that you, as a CEO, as a leader of your organization, you're on top of your cash flow forecast. I'm going to stop here because we have 2 minutes left, and we will cover the rest in terms of the investment reprioritization. I know that this is a big mouthful. I'm very thankful for Lama. She was a bit stressed, especially having me next to her. This is why I decided to move a bit so as to give her the space to be able to present to 110 of you. This is a big turnout. We appreciate it. We hope that you took value out of it. We will continue this by looking at other fundamental elements in financial management in terms of developing your financial model, in determining what is the valuation of your company. This is something that we're doing with actually several of you. Several of you, we're looking at your financial model. We're looking at the valuation of your company. We're looking at ways to be able to improve this value through different measures that we will cover with you. So any questions before we close? We have 1 minute left. Any questions, any feedback? No question, very silent.
Thank you all for adding the emails so that we can send you the slides and then add you to our distribution list for the upcoming workshops. So those who haven't yet typed their email addresses, please do so.
Thank you. Chital, thank you for hosting us. This is an EHS training session. It's also, we have the pleasure to also share this with others. One could even partner or could be client of. Wish you all a great end of the week. Thank you for your patience. We will have the timing of the next session on our LinkedIn site. If you're not signed up, please sign up on the LinkedIn. Viral, yes, you raise your hand. Viral, any questions? I will be coming to Mombasa and to Nairobi. So we look forward to sitting down with you and with the family in late September.
Finally, good to know, Constantin. No, it was a mistake. All good, thanks. And looking forward to seeing you soon.
But it's a good opportunity to see all of you. So we'll communicate the dates when we'll be in Nairobi and look forward to having a session with you on the board. All the best to all of you.
Thank you, Constantin, as always. Look forward to the next session. Thank you so much.
Thank you.
Take care. Bye.
Thank you all.